Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today's our favorite, the Primary Vision Frac Spread Day, where we get to talk about some U.S. activity, what's happening within the U.S. for the most part, and then we're going to go abroad, look at some of the data from OPEC and some loading schedules, in terms of some of the adjustments that we've seen with more deferrals getting kicked into July. And then looking at it, what recent inflation data and spending data has come out for the U.S., just looking at how does that recovery really appear to be doing for the most part. So without further ado, we get to jump right in. So we had an increase of 3. So we went from 223 active spreads to 226. Now, as we were saying last week, we were expecting to start to see a little bit of an increase heading into June, as this is when we were going to start to see that next move higher. But just because there is this friction, if you will, in terms of getting labor, getting equipment, what does that new contract look like? And a lot of the commentary that we've seen, heard, has been that there's going to be an agreement between the OFS and E&Ps to start passing through some of those additional costs that we've seen in terms of buying new equipment, because some of the equipment, well, I shouldn't say all new equipment, but just replacing parts and pieces that need to go in on that cold stacked, and then trying to go out and hiring just new people, because let's be fair, the market is getting heated, and when you look at cost, how many people want to come back into the oil patch after being laid off 2-3 times over the last few cycles? So again, those are some of the things that we like to look at to understand, okay, well, how much cost is going to get pushed through and how much new equipment can actually come back quickly. And that's where we start to think that we can have a pretty steady move to about 235. And then you're going to start to see, okay, where's the labor coming from? How quickly can we get those parts to get this spread back into the market? We did have an increase of 5 in the Permian, and then we had some slowdowns in some of the gas basins. But the one that we're watching the most right now is really the Bakken or Williston, because DAPL has now been kicked to the right, where the judge has said that they can stay operational until the environmental study is done, which is due for anywhere between March and May of 2022. So that's where we think we're going to see a little bit of that increase, where we do have some spare spreads up there that can come back fairly in short order. And I think we make our way to 20 over the next, let's call it, 6 to 8 weeks, as we start to see some of that accumulation, because production has come down in the Bakken. Now, but we never want this to be an infomercial, and we always want to talk about our data, our content, really showing what we're doing. But one of the things that we've been very adamant that we had already been above 11 to 11.1 million barrels a day of crude production, because we're using the frac spreads. We're getting as close to the production profile as possible. Rigs are good. They're obviously very important in the process, but when we're talking about near-term production, this data gets you there. And just to reiterate why, well, when we look at the EIA, so they adjusted their March output to be at 11.184 million barrels a day in March. And we were saying that, all right, we're already getting close to about 11.1, and now that's why we've taken our estimates. Our estimates were about 11.3 to 11.5 million. Now we're saying it's going to be 11.5 to 11.7, but that's the 11.7 is going to be very difficult to hit. Our view is that we're really going to get close to that 11.5 just based on where this activity is coming from. And now this is why we talk about this data so much. This is why we offer it to clients, because this is going to help you dictate, okay, where is production? What do I need to lock down on? And then we try to tie this in with the global macro to understand where some of these key drivers are, because we are 13% of supply and 20% of demand. So you have to appreciate, where is this going? Who's buying it? Where is it getting exported to? Especially when we start talking about NGLs and condensate, which we're putting together a bigger report on. And then we're going to have a model to help you predict and project and play with what your expectations are, for clients. So please reach out if you're interested. Now, when we look over the last 3 months, you can see how this is what we were talking about, where we're going to get this strong surge coming out of Q1, Q2, work down those ducks, especially when you look at where crude prices went. But then we were going to start to balance out, and then we're going to start to see rigs catch up. So rigs have continued to catch up, and one of the things that we've heard from people on the street is really that we're going to see that Q3 move. We've seen it with conversations, with what we've with I think what a lot of the companies have been saying at this point in time, that Q3 was going to be survive through Q1, Q2, and then get back, and then reassess in Q3, and then start to increase some of that activity. And now that had gotten pulled forward, which is why we had adjusted some of our views in terms of where things were going. But now we think that rigs are going to start to pick back up. We've already started to hear about some programs that are being that are going to start rolling out, and this will keep the spreads moving at a fairly steady clip higher. But again, the rigs are going to outpace spreads at this point, and then we think we're going to get another push in spreads as we go through July into August. And then when you look at it against the 2020, this is why it's so important. So 2020 in terms of the numbers don't matter as much. This is a lot of spreads that you can see that were just cold stacked. So you can cold stack anything. It's just how are you maintaining it? What kind of elements is it going to be subject to? Are you doing the right things for it? Or are you taking pieces off to keep other equipment running? And this is why you had a huge, all of a sudden, all of this equipment was just sidelined. And now as you start to see some of this creep back, well, how much of it was stripped down? How much of it is still usable? And these are the points of contention in terms of how much of that price is going to get pushed through, because steel, diesel, labor, it's all higher. So then when you look at the supply chains, which we'll talk about in a minute, on inventories being low, having to go out there and order new equipment. Well, if I order it today, when am I going to get it? Is it 6 weeks? Is it 6 months? And this is why they're starting to get some of this, I don't want to say fear, but this drive to start closing some of these deals to make sure that when the companies want that equipment, it is available. And again, these are some of those friction points, and will start to impact how quick activity comes back and what pricing pressure looks like. Because right now prices are still fairly competitive. It's not like the OFS side has gotten this huge pricing premium, but they've always passed through a lot of these costs. So now it's what kind of margin can they get on the back end, especially given where we sit today as we head into a fairly strong pricing market, but also just in terms of where the U.S. demand is as we look to OPEC. So OPEC has been talking about what are they bringing back, how much are they bringing back. So we've talked about Iran and the estimates of the amount of crude that is sitting offshore waiting for some sort of deal. We know that they've been exporting more into China through either ship-to-ship transfer off the coast of Malaysia, getting flagged as Malaysian, or just going under their own power because they do have their own boats. But these are some of the growths that we want to talk about, because Angola's been well below where they could be just based on a production, because they keep either deferring or just cutting the amount of exports that they have. Now, there's a mixture of it's starting to get a little tough. They need some investment to pick up some of this production, but they're also not seeing the demand that they were expecting, because China is just being a bit pickier as to what are they buying, where are they buying it from, and Iran has really started to displace some of that Angolan crude. Now, Iran is the one that isn't reflected here. So when we look at Iraq, we've seen a pretty steady increase, and then Libya isn't included, even though we've seen them come to about 1.1 million barrels a day on a pretty consistent level, which is going to remain. We'll touch on Saudi Arabia in a minute, but Nigeria is the one that is the interesting, because they should be at about 1.5. They've been closer to about 1.6, but between just Wednesday and today, we had another 100,000 barrels a day in June get kicked into July. So we already had another deferral, and we'll go through some of those cargoes, because that's really important. Because the reason why we talk about West Africa so much is because that's the area that posts its first loading schedule, and they typically fall under the medium sweet category, or a Goldilocks setup, because it can pretty much go into any real process to create a fairly strong suite of refined products. And the fact that they're struggling so much means that there's either cheaper prices available, or there's their main buyers, which has been Asia, just aren't coming back to the same level, and they're having to compete into other markets, which is why when we look at Gabon, we look at Congo, they've also cut exports as well. Congo was because they've already seen some deferrals, and now Gabon just because, again, trying to alleviate the need for floating storage. So then when we look to Russia, Russia's been outproducing their current levels and have been much closer to about 9.8 to 10.1 million barrels a day. But you can see where they should be. Now, the reason why we skipped Saudi Arabia is because Saudi Arabia, technically, based on the deal that was created, should be in May at 9.2. But remember, they had an additional million barrels a day cut. So they're bringing that back separately. So that's why when you get to July, when now under the OPEC agreement, they're supposed to be in July at 9.495. And then in July, all of that will come back and they will be at that 9.495. So again, that's closing the gap on that additional million barrels. So we have what OPEC is bringing back plus what Saudi Aramco is bringing back, which is going to increase that level. Now, as they bring back this new crude, they're going to increase the amount of refining, which is why they dump some of that gasoline, which is continuing to hit the in Pad 1, and we do have more refined products coming into the U.S., which we'll talk about in a minute. Now, this is one that I just wanted to touch on again because we see Russia has moved to a 14-month high on Urals, which if you look at just prices have tightened up a bit. They on the physical side, they've actually gotten a little bit better. They went from Urals, Total bought Urals from Glencore at $1.65 less dated Brent versus the previous $1.85. So you're starting to get a little bit of tightness in the market, which is a positive from the Urals side. But it's also because we're seeing these barrels getting kicked to the side. So we do have the UK. You can see that's where we have the work being done. So that has taken some barrels out of the North Sea and in terms of Europe in general. But when you look at Norway has picked back up. They've now closed, fixed everything the maintenance season and whatnot. So now when you look at Nigeria, Nigeria previously, this June number was at about 1.7, and now it's down to 1.5, and it's gotten kicked over. So it happened over stages. So over the last 2 weeks, we've seen deferrals come across. And where have we seen that? So the Nigeria plans to defer loadings for several crude grades from June into July. So we had 3 of Bonny. We had out of 8 of Forcados. We had 2 getting kicked over. Bonga has had 2 also deferred. In terms of the revised. Now, they also had a May that was deferred. So we keep seeing April going to May going to June, now June going to July. And West African crude, now we did get IOCs buying. Now, to be clear, that has been India. So despite the refiners' return to crude tendering the past 2 weeks, IOC's purchases of West African grades remain below the typical monthly volumes. So not only did India skip a month, but they still are well below where they're supposed to be at this given time, which is why we continue to see the pressure in West Africa. And we're just not seeing the flows out of the Middle East as well, which is why we've seen some of that pressure come into OSPs, with Nigeria maintaining the second lowest OSP differentials that we've had outside of 2020. And it's just because there keeps being these shifts. So Malaysia is now heading into a 14-day national lockdown kicking off June 1st. And we're starting to see an increase in the Indian variant that is spreading throughout Asia. Now, the reason why that's a problem is just because they don't have the vaccine pace that we have in Europe and in the US, which is leaving them open to another surge, which again is just keeping people cautious and limiting the amount of travel. Now, with that being said, we've been talking about the amount of product that has come into the Atlantic Basin, and it's starting to show up in the European numbers. So we'll go through this in more detail on Thursday, because Monday we get the kick over. So here you can see that there was a build across the board, and the jet one was fairly big as they took down more jet. Gas oil rose as well. Naphtha exports have started to increase into Asia for petchem. But the gasoline side is the most concerning because we did get a big surge of product leaving Europe, and now it's back being filled. But we do have more behind it. And if you just look at the spreads between the US and Europe, we're going to continue to see those flows. And Singapore, seeing that big drop, you're essentially seeing the timing in real time. So we've seen those cargoes leave Singapore. India is tendering several more gasoline cargoes, which will end up in the Atlantic Basin. We have more coming into Pad 5 in the U.S. But this is where, when you look at Singapore and when we talk about what is happening in Asia, some of this will end up in the Atlantic Basin, and some of it will replenish what has been sold out of Singapore already. So that's why we expect to see the middle distillate side come back up. Residual is really getting recracked right now, and in terms of what the resid is. So the U.S. has actually been importing a bit more residual and using that to crack into other products. And again, trying to play with these numbers. But when we look at VLCCs, so China and the U.S. have seen a pickup in VLCCs. India has seen a pickup of 2, but still remains well off of normal. But again, we'll talk about that next week as well. One of the interesting things is when we look at China crude inventories on the depot side for the WARRANT weekly. So this is looking at what is going to be filled into the overall, what's the best way to put it? The overall commodities world in terms of their futures. Here you can see that we're getting a big increase. Now, a big increase is just taking us back after seeing that steady decline, because we are seeing more crude show up and some of these disconnects in terms of what can be purchased ahead of the levies, as we do have the deep teapots that are buying less, given the pressure that they're seeing, which is where we continue to see Shandong storage remain at seasonally adjusted all-time highs, and the highs for 2021 just kind of sitting there. And the problem with that is they're taking in more crude, but they're also seeing a big increase in fuel oil stocks, which are now at a 2021 high. So this is where we're going to continue to see this struggle in terms of, well, how much can they export? How much can they recrack? What is going to happen with the light cycle crude and bitumen additional levies? How is that going to adjust? And we're already starting to see that shake out and reverberate through the system, specifically in Asia, pushing more into the market, but at the same time, just hurting just teapots that are going to have to cut runs if this continues, which is going to leave crude on shifting into the SOEs. Again, this is why we talk about the overall supply chains, because Asia's struggles is just going to push product and crude into the U.S. market. So even though the U.S. is getting better, and it's still not at 2019 levels, which are weak numbers to begin with, but they're still rising on a seasonal level. They're still getting back to to a more normal state. But at the same time, this is a movable product, which is going to continue to shift into the U.S. All the while, the U.S. is struggling under a flood of just liquidity. Now, given that we did get a small drop in what the RRP was this week today, after seeing a big spike yesterday. So yesterday was a record. Now we had a small drop to just below 500. But you can see that even though we had the small drop, it's still the second largest, essentially since the RRP was instituted at this level, just talking about taking that cap. Now, we talk about this in segments 1 and 2 of the Econ Show, so I'm not going to go into depth as to why this is so important. But it's just showing you that there's so much liquidity that banks are essentially giving it to the Fed in exchange for something that's yielding 0%, because they have so many deposits on hand. Now, all of these previous highs were either yearly or quarterly ends. So now we're having this happen at essentially mid-May into the back half of May, and typically this signifies that the Fed is much closer to tapering than easing, because this is just highlighting that we have now managed full saturation of liquidity. And banks have to put it somewhere temporarily. They can either do it overnight or on a term basis. So this is only temporarily pulling liquidity out. All you're doing is saying that I can't handle this right now, but they're deposits, which is a liability to the bank or a financial institution, which means they will need this back. So it's just temporarily moving this to eventually put it back into the system, which is why this is going to become a bigger problem. All the while, inflation continues to move up. So personal consumption expenditures, or the U.S. Core PCE Price Index, which is the Fed's favorite way of measuring inflation, even though they'll come up with what reasons why this is transitory. You can see that we're now well above their target. We're well above where we have been in previous years, and we're at about 3.06%. So you could sit there and say, well, you're talking about this on a year-over-year level. 2020 was deflationary. Yeah, so let's look at it month over month. So now we can look at the U.S. is risking deflation. So core PC prices increased by 0.7% in April. And as we've been talking about in our research that we sent out to clients last Friday, as we've been talking about in the econ shows, each month is going higher, and just based on the supply chain, going back to PPIs in China, Japan, South Korea, Germany, to freight, to import costs, to trucking, all of those prices are continuing to increase. Prices paid versus prices received continue to see the disconnect, which means that companies are going to continue to try to recover as much cost as possible. So personal expenditures, you can see we're up 0.6 month over month. On expenditures on a year over year, up 3.6. And then when we look at core, so core price index was up 0.66. So you can see that we're breaking out to those highs, and then that's resulting in the level. So when you look at this, what happens overall? And this is where we start going from inflation into when do we get stagflation. So that's why when we look at real consumption, so real consumption actually fell by 0.1%. So we have inflation going up and real consumption falling, which again, coming to the stagflation, because when does the market, when does the consumer reject higher prices? And then that's when we start looking at personal income, which was down 13.1%, but would make sense after you had that big spike from the transfers, as we had the government continuing to stimulate with the stimulus package. But when we look at nominal dollars in terms of personal consumption, it was up 0.5. But then when we look at the real dollars, it was down negative 0.1. Which is when we start looking at let's look at inventory. So again, inventories were down to 0.8. And then the change month over month was negative 1.6. So this is why companies have no choice to just take whatever price is given in the market, because they're so low on inventories. And when you start taking this because you can say, well, they were lower in 2020, which is true, but you also didn't have sales at the same ratio. So now you have sales that are increasing, and the sales to inventory ratio is the worst it's been, as we talked about in this past econ show. So there's a lot of things moving about in terms of, some things are getting better, but then there's some headwinds in terms of where the liquidity is, what kind of flow we're looking at. And then next week we're going to have jobs data, which will be interesting to see how much did we get back in terms of new jobs coming to market. What do we have going on in general, because we did get the GDP numbers. We'll talk about that next week. These were the ones that we wanted to pull out ahead of the long weekend. So hopefully everyone has some fun plans, get to take advantage of the long Memorial Day weekend. So we just want to say happy Memorial Day from the PVN team. And thank you for your support. Please like, share, subscribe. Anything you can do would be very helpful. I'm looking forward to a haircut. That'll be sure. And then my oldest will be marching in her first Memorial Day parade. And I am a T-ball coach, so I'll be with her. So that'll be fun in general. Hopefully we'll have some fun pictures. But please have a great, happy, healthy, and safe long weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network.